high pivot and high pivot align with the low pivots right here. That gave us a technical reason why gold should sell off, but that also means that gold should find major support around this 25.50 level. So there's not a lot of downside left. Now, listen, in all fairness, could gold break lower here? Yes. But you have to assume at least this will be some sort of support. And again, if you ask me where gold is next year, eventually I think it's at 3,000. I do think 2025, you see 3,000 an ounce at least. I think silver comes down to about the 29 to 28 level here. And that's where you'll see that next major support level where you start to get another leg up.
Gold prices ended their third consecutive weekly decline last Friday, with gold dollar falling over 4.5% for the week. The market has seen a sharp correction, with prices dropping more than 9% from recent highs. This pullback has tested the initial support level of the 2023 uptrend, with the sell-off finding some exhaustion near the median line of the trend. While the immediate decline hints at vulnerability, the broader trend remains intact as markets await the new week. Weekly technical indicators highlight weakening momentum, with the relative strength index reversing from overbought conditions and slipping below 70 for the first time since the August breakout. Despite the recent pressure, the long-term outlook for gold remains positive. Market analyst Gareth Soloway predicts gold prices could climb to $3,000 an ounce by 2025. His forecast is underpinned by macroeconomic factors such as increasing U.S. deficits, rising interest rates, and the eventual shift toward monetary easing, which could weaken the dollar and drive gold higher over the long term. Silver, on the other hand, continues to face significant challenges. Unlike gold, silver has not reached new all-time highs and remains heavily influenced by its industrial use. The metal recently broke through minor support levels and is approaching a critical zone between $28 and $29, which Gareth views as a potential base for recovery. However, strong demand for the US dollar has added to the downward pressure, tying silver's immediate prospects closely to the dollar's performance. The strength of the US dollar remains a key factor shaping the near-term trajectories of gold and silver. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
Ultimately, gold ran up and amazingly pushed near 2,800. We've now seen it correct back towards 2,600. There shouldn't be much more downside. And again, I think you have the risk on trade right now. Everyone's jumping into crypto. Everyone's going into high risk tech stocks and small caps and mid caps. All of those things work against the idea that, gold is where you want to be. But ultimately, the end game stays the same, which is the U.S. deficit is likely going a lot higher. Countries eventually will demand more interest on our debt. We're already seeing interest rates over the last couple of months going higher and higher because of that expectation. And then ultimately, they're going to have to print their way out of it, right? So the dollar declines eventually, and we see gold eventually going, or I should say the dollar dropping and gold continuing to go higher. So I do have my charts back here, so let's jump right into it. If we go to the daily chart, so this really shows you why gold is pulling back. Going back to March of this year, which is, by the way, in March is when Bitcoin topped. Look at how that was the beginning of the bull run in gold. All right, so now you see Bitcoin bottomed, or the bull run in Bitcoin just started a couple of weeks ago, and that was the top in gold here. So we can also see here that you have a trend line. Let me bring up this and go back to regular charts, is that high pivot and high pivot align with the low pivots right here. That gave us a technical reason why gold should sell off, but that also means that gold should find major support around this 25.50 level. So there's not a lot of downside left. Now, listen, in all fairness, could gold break lower here? Yes. But you have to assume at least this will be some sort of support. And again, if you ask me where gold is next year, eventually I think it's at 3,000. I do think 2025, you see 3,000 an ounce at least.
Are we a little overstretched on the sell side? Have we oversold?
So you're getting to that point. Yeah, you are getting to that point. But again, if you look at the scheme of the bull run starting in, again, February or March, and we just do a Fibonacci retrace of that move, we're not even at the 382 yet. So I would say short term, yes. But don't be overly surprised if they try to flush out more weak hands. And that's one thing that the market, and I've learned this the hard way many times in my early years, is that, in general, the market wants to push the market higher, in this case, gold, to get those few people on the sidelines that weren't in gold. They want them to be like, oh, okay, fine, I'll buy gold. And then as soon as they do that, it reverses, right? It's the old FOMO in trade where it just, people are getting in at the highs. On the other side, the markets want to flush those people out, the weak hands out, as they say. And so they want to bring it down. So they may bring it down a little bit lower than that lower area of that channel, ultimately to kind of get those weak hands out. And then I think they take it back up and make new all-time highs. Yeah, silver's a little trickier. And again, the biggest thing on silver here, if we take a look at the charts, is that you basically have this scenario where silver is an industrial metal. And this is interesting because, number one, we haven't seen new all-time highs on silver. We're way far away from that. So you know that there's a different angle there than the safety trade of gold and why gold's just been going higher and higher until this recent correction. But you've still seen silver trading down here. And we've just broken another short-term minor support. I think silver comes down to about the 29 to 28 level here. And that's where you'll see that next major support level where you start to get another leg up. So I actually think that we're going to see, and again, this is the economic side of things, is that I'm expecting a economy here in the US that is going to show more and more weak signs to the point where the Fed is going to want to cut more and more, and they will cut. But I do fear that on the other side, inflation is going to be bottoming out here around 2.5% and start turning back up into the low to mid threes. And that is going to create that potential for that stagflation. And also that potential where the Fed is going to have a really hard time cutting rates enough to stimulate us out of a recession, even if it's a minor recession, because of that inflation bug not going back in the box.
Economic downturns often prompt the U.S. government to deploy fiscal stimulus measures, including increased spending and debt accumulation, to stabilize growth. However, as Gareth Soloway points out, this approach can become problematic when paired with rising interest rates. Higher borrowing costs during economic weakness can exacerbate fiscal pressures, potentially creating a self-reinforcing cycle of escalating debt and constrained economic recovery. The broader implications of such fiscal challenges are profound. Goldman Sachs economists estimate that a breach of the U.S. debt ceiling, when the government fails to meet its financial obligations, could immediately halt around 10% of U.S. economic activity. According to the center-left think tank Third Way, a default scenario could have devastating consequences, including the loss of 3 million jobs, a $130,000 increase in the cost of an average 30-year mortgage, and a surge in interest rates that would add $850 billion to the national debt. This rise in borrowing costs could further divert taxpayer funds from critical federal infrastructure, education, and healthcare investments. The compounding effects of higher interest rates and ballooning debt present a significant economic risk. Rising rates strain government budgets and impact broader economic conditions by increasing borrowing costs for businesses and consumers. For instance, higher mortgage rates could suppress home buying, while increased corporate borrowing costs could dampen investment and growth. Let's get back to the interview.
And this is the real conundrum that the government is going to face, is that they need rates to go lower, because otherwise, how do they pay all this debt, right? How do they pay the service on the debt? And if you have that uptick in inflation, it's going to make it that the rest of the world will demand higher interest rates. And one thing I love to point out to people is that, think about what the Fed has done recently. About 2 months ago, they cut 50 basis points. Just in the last week, they cut 25. So they cut 75 basis points. And what did yields do? Yields went vertical and rallied up. And what that tells us should scare all of us, to the point of, it says that the Fed does not have absolute control of rates. And ultimately, what has control? The market, right? So if you need other countries to buy our debt, or other players to buy our debt, and they refuse, what is the Fed going to just buy all the U.S. debt? Well, again, that's insolvency in the making. And again, that's not a good thing. So you have to allow for interest rates to go up to the point where it says, okay, this country here will now take on our debt because we're going to pay them, 5% or 7% or whatever it may be. If yields are going higher because the economy is strong, which I think is what we've been seeing since that Fed 50 basis point rate cut, I think, and I was in the same camp, is that when the Fed cut 50 basis points, I said, I don't get why they're cutting 50 basis points. The economy seems pretty strong. I must be missing something. There must be something they're seeing that is hugely negative for the economy. And then we got data point after data point after data point that was strong. And so it's like, wait a minute. Okay, so the economy is strong. So rates went up because they were anticipating less future rate cuts by the Fed because of a stronger economy. Now, the kicker is this. If the economy starts to slip and go downhill, but then our debt just escalates, because remember, we generally as a country, you stimulate by spending money and racking up debt during recessions. So if rates go up because it's a weak economy, but we're just jacking up the debt, then that's where it's a negative. I think in general, it's going to be a combination. So you'll have certain things where, like a copper, right? Copper, nickel, these things may struggle a little bit because of the weaker global economy. In fact, we've seen nickel come way off of its highs. Even copper's down hugely on the charts. Those are coming down because China's weak and the rest of the world is relatively weak, even though the U.S. is strong. So if the U.S. slips into recession plus the rest of the world stays that way, then those commodities in the short term will come down. But eventually, inflation is inflation. It'll take all of those commodities back up down the line.
The interplay between fiscal policies, rising interest rates, and their impact on gold and silver markets highlights the fragility of the current economic environment. While gold's long-term prospects remain promising due to macroeconomic factors like mounting deficits and monetary easing, silver's immediate trajectory depends on industrial demand and dollar performance. Both metals reflect broader economic challenges, underscoring the importance of strategic positioning in turbulent times. How can investors adapt their strategies to navigate the dual pressures of rising interest rates and fiscal constraints while capitalizing on opportunities in precious metals? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.